Everybody, Marty Mazur, February 22nd, 2017, your weekly video. Once again, I'm going to run through this week's client slide presentation, starting with this graph we haven't looked at in a while. This is the business cycle. We're going to focus on tops this week, the fact that bonds tend to peak during the cycle before stocks. Stocks do kind of when the cycle peaks, commodities a little later, and so on. Taking a look at the last 20 years before the 2001 recession, sure enough, bonds peaked first, then stocks, then commodities. Moving out of that recession and into the next one, about halfway through, bonds peaked once again, right on cue. Then stocks just after the recession officially began, which is something we never know except in retrospect. And then the commodities about halfway through. And here we are coming out of that recession. The bottoming here was on cue, but again, we're going to focus on the tops. We thought in 2013 that bonds may be peaking, so I have a 1 there. Stocks never did. Stocks continued to move higher throughout that period. Commodities actually began drifting lower back in here and really fell off a cliff in 2014. But now we know that that wasn't the peak in bonds. We got no recession in here, and bonds went higher once again. I have the most recent one that's here just in late 2016. My best guess is that probably is the peak in bonds, but of course you never know. Stocks continue to go higher, and interestingly, commodities are now moving higher, and we had no recession in here like the chart would have suggested we should have. Here we are zeroing in on the markets past the last recession. So now we look back historically, at least recent history, and see if there's any similar looking chart patterns. Here we are coming out of the early 80s recession. Sure enough, we thought we had a peak in bonds, but again, we found out later that we didn't. Might have been able to put a number 2 in here, but I didn't. And yes, commodities did peak, kind of like they have here recently. And then again, no recession. And here commodities were actually staging a comeback. What happened after that? Well, we had actually several more years of a good upward sloping market in stocks. Of course, bonds continued to go lower. That was indeed the peak. Stocks didn't peak until right in that recession, and then finally commodities did later in the 1990-91 recession. So here's a look at the 80s all the way through. The economists call this a double cycle. We had indicators here that maybe we should have worried about recession. Usually commodities fall off when we are in recessionary circumstances, and that just didn't happen. So we had what economists call a double cycle. Here's a look again at the last 20 years. Here we did have in the later 90s commodities peak and come down a bit, but stocks continued to go higher, kind of zeroing in on that. Here's that peak in commodities, here's stocks, here's bonds, and then we had a few more years from at least that commodity peak, and here we are turning up. Maybe that's similar to where we are now, but that happened at a period where there was, a year and a half, 2 years to go before the next recession. How did stocks look going into past recessions? Here's the 50-day moving average on the S&P 500. Here's the 200-day, as I've shown you numerous times. These two interact to give us trend indications. You typically, when the green is above the blue and they're both sloping in an up direction, that says good things, but we also want to see the index trading above both moving averages, and we didn't have that much in here. And here we have it breaking down, moving into the 81 recession. What does today look like? Well, much different. We have the index trading nicely above the moving averages and both sloping very much in the right direction. Going into the 90s recession, had some turmoil going in here. Better look here, although it broke down soon into the recession. This trend here looks markedly different than this trend does here recently. Going into the 2001 recession, very bearish look, 200 above the 50, the index trading below both sloping downward. Rocket science wasn't necessary to tell us we were in a very bearish look for the market. We're in a very bearish period for stocks going into the 2001 recession. And here we are again today, going into the 2008-2009 recession, things breaking down clearly. And as you can see, the breakdown happened just after we officially entered the recession. Once again, here's how we look today. Of course, course, when things are getting scary, then government securities are going to rise. Here we are going into the 1990 recession with government securities going up while stocks were going down. Moving averages look bullish for government securities. Here's government securities today, much more bearish look than we experienced going into that recession, although we're seeing some things converge a little bit here. We'll see what that portends going forward. Here we were going into the 2001 recession, government securities rallying nicely as they should when we fear a breakdown in the economy. Again, today, here we are going into the 2008 recession. Treasuries trading up very nicely and versus today. My favorite economic indicator, once again, the yield curve. When this line drops below this line, that means the 10-year yield is lower than the 2-year yield, a very ominous sign for the recovery. Here's the last 5 recessions. You can see the recession didn't happen until we had an inverted yield curve before each and every instance. It's very unusual to have a recession without being preceded by an inverted yield curve. And you can see we're nowhere near inversion. Economists seem to be getting it all wrong this year. This is the Economic Surprise Index put together by Citigroup. It gauges the actual economic data as it comes in relative to what economists had forecast. So as you can see, since the election, economists were much more bearish on the economy than what was really going on, for what that's worth. A little more on the market, looking at trends. Here's a 30-year look at the S&P and the 24 months, so a 2-year exponential moving average. I use this one when I want to give more weight to the current data, and it's a more sensitive indicator versus the simple moving averages, which I just showed you. So here we are going into the early 2000s recession, and here we have the EMA, or the moving average, rolling over, giving us a signal that things are getting bad for stocks. Sure enough, they were. Here we have it moving back up, then rolling over in the last recession. Here's that 24-month moving average today. As you can see, very bullish look for stocks, at least as we sit here today. The moving average convergence divergence, I show you this a lot. This is a long term, again, that 30-year chart. This is the monthly look, so it's a 12-month moving average minus the 26. This is the moving average of those two, and this is the signal line. Technicians would tell you when the MACD drops below the signal line, that's a sell signal. We got a little bit of a sell in there. Said to buy it back here, said to sell it here before the early 2000s recession. Big bear market we had in there. Right here, gave a buy signal. Pretty good indicator, as you can see. Right in here, right there, pretty much at the peak. Maybe just slightly after the peak in 2007, got a strong sell signal. Huge bear market, gave you the buy signal there. Here we are today. Here's those corrections, and right now, folks, we have certainly a look that looks more like the early stages of a bullish uptrend than it does the later stages. No guarantees. We're just talking about probabilities based on the indicators. Looking at the S&P, bringing back the 50 and 200 day. I'm doing this to set you up for the sectors. Here's that 20-year chart. You can see the rollover again, just another look at the same thing. Here's the look today. Here's the look for financial stocks. What I'm going to do this week, folks, is take you through the sectors based on our weightings. We have our largest weightings to financials, and as you can see, the moving averages are showing a very bullish trend right now in financials. Then we have the next largest in industrials. Good look for industrials. Materials, good look for materials. Technology, very good look this year for technology stocks. Consumer discretionary is our next with a 10% target. And we have energy. Energy's having a tough go of it here of late. Now we're touching against that 200 day. A week or two ago, I said it wouldn't surprise me if the energy sector doesn't bounce off of that. And sure enough, looks like that's what's happening right now. So energy has been the worst performing sector so far this year. We have a 10% weighting there. We have 8% target to staples. Staples, as you can see, that's a bearish setup for the moving averages, although they seem to be coming back here a bit of late. Same for healthcare. Big bounce lately off of healthcare. If that moves above the blue here, that would be the 50-day above the 200-day. That would be a bullish signal to technicians. We only have a 5% allocation to telecom. You can see the moving averages are in the right place, but kind of a tough go in that more defensive sector. Utilities, we have a 0 target to utilities. You can see they've struggled of late, although they've begun to come back, and that looks like a little better setup for utilities going forward. Looking at the sectors and just in raw returns from the election, I think I showed you this last time, but one more time, here we are updated through yesterday. You can see financials leading the way, industrials, technologies, cyclicals, and materials. Then you have the more defensive sectors, telecom, consumer staples, utilities, and healthcare. But again, energy really bringing up the rear here of late. But when we look at it simply on a year-to-date basis, actually technology is number one. Interestingly, healthcare has really come on strong so far this year, followed by consumer cyclicals, industrials, staples. Interestingly, I think the setup remains very, very good for financials. Then we have materials, utilities, telecom, and energy continuing to bring up the rear. So folks, kind of a mixed picture sector by sector so far year to date. Again, the setup, as you can see, and as I've been illustrating week after week, remains good for U.S. equities. In fact, I think it remains good for global equities going forward. That said, folks, even in the best of years, we have many, many drawbacks, some of them quite scary. So as they happen, and I don't think it's an if, I think it's a when, I'll be here each week to give you some color and some perspective, and I'll leave it there. Thank you, as always, for watching and listening. I'll have the weekly message here in the next couple of days. Take care. Bye.